Welcome to our webinar on operational considerations for bank-offered systematic risk premium strategies. I'm Jerome Abernathy of Hedge Fund Research, the sponsor of this webinar. In this installment of our webinar series, we'll go over the operational considerations when investing directly in bank-offered systematic risk premium strategies. In this webinar, we'll cover all the basic information you'll need to execute and manage investments in these strategies. We'll cover a variety of topics, including how to gain access to these strategies, how trades are structured, how to manage positions, and where are the key operational risks and considerations. These strategies are mostly accessed via swaps. I'll assume you have a credit line, that is an ISDA, in place with the bank. By entering into a swap agreement, an investor pays transaction fees to the bank and receives the returns of the strategy. Remember, a strategy is simply a calculation that references securities prices. No one is actually trading anything on your behalf. So when you invest, say, $1 million notional in a strategy, you'll receive or pay cash payments corresponding to the return of the strategy on your investment. The key considerations for the swap are the tenor, that is the length of the contractual agreement, the dates for exchanging payments, those are called the resets, and of course the transaction fees. There are a number of other important considerations as well. At the core of your investment is the swap trade confirm. This is the legal document that summarizes the terms of your investment, which strategy you're investing in, the fees, tenor, everything. The key terms listed in a confirm are the strategy name, ticker, and rules, the notional amount to be traded, the trade effective and termination dates, early termination provisions, payment dates, business day and day count conventions for fee and return calculations, the fees, change in notional, running swap level fees, early termination, advance notice periods for changing notional, termination, etc., the independent amount, which is the margin you have to post with the bank, if any at all, and disruption event definitions. So let's step through an example of a trade confirm. The beginning of each confirm lists the strategy you're invested in. An important point, as we covered in the last webinar on due diligence, the rules for the strategy are an integral part of the confirm. And of course, we have to know how much we're investing. In this confirm, we also list the payment terms, 3 days, and reference the payment dates where you'll either receive or make payment depending on whether you made or lost money for the period. We have to know the trade date and the date on which the trade goes into effect. Here are terms for ending the trade. It can be at the maturity of the swap or early termination by either you or the bank. Here are some technical details. Business days are those days where the bank is open for business so you can trade in or out and when the swap is priced. Disruption days, which we'll get into in a bit, are business days where the bank can't transact because the exchange for one of the reference instruments is closed for whatever reason, such as a holiday. The day count convention is for fee and return calculation purposes. In this case, they're using actual 360. The independent amount is the margin you put up with the bank to support the trade, just like futures. If you fully collateralize a trade, for example, if you have a fund that has the full notional amount of the trade in cash, like a mutual fund, or you just have to be a very well capitalized counterparty otherwise, the bank might not require you to put up any margin. As we covered in the due diligence webinar, a bank might charge an upfront or in fee. This is their cost for putting on the initial positions. Here are the payment terms again. In this case, settle within 3 business days. Here's where the payment dates are listed. In this case, it's monthly. And here's where the payment amount is calculated based on the strategy returns, the notional amount invested, fees, and day count. At some point, you may want to increase or decrease the size of your position. Here are the terms for doing so. Often there's a change in notional fee that represents the cost of putting on or taking off the implicit positions. The bank actually has to trade the hedge on their side, so they do incur costs that they pass on in the form of this fee. Here's the fee amount. They're charging for upsizing positions, but not for downsizing positions. Your position in the strategy can be terminated early for a number of reasons. This trade can terminate if it's down 70%, or the trade can be terminated if there's a disruption event. In this case, if there's a material change in law, an increase in the cost of hedging, currency disruption event, or if the price data needed to calculate the strategy is no longer available. So those are the major items to look out for in a trade confirm. They revolve around the timing of payments, fees, and how they're calculated, and early termination and disruption date provisions. So now let's move on to explore a few other items. Most investors like to know what implicit positions they have on and feed them into their risk systems. The banks can either FTP or email you the underlying implicit positions for a strategy in whatever format you need. Usually these files are sent in the overnight. You'll also need to manage your margin, that is the independent amount and cash position. That way you'll track how much money you have to receive or send to the bank at resets and whether you need to top off your margin. You can set up a simple spreadsheet that tracks your cash position based on your initial amount invested, the returns of the strategy, and accrued fees. Here are some other operational details you need to be aware of. First, you can't cross margin between strategies, and of course you can't cross margin between banks. Also, the frequency of disruption days for strategies that use global markets are higher than strategies that trade in a single country because global strategies will combine the holidays of multiple countries. You should be aware of the NAV reporting time of day. If you need the NAV to be reported at a certain time, you should make sure that the bank is capable of delivering the NAV at that time. Also, you should be aware of the settlement currency. When you pick a strategy, it's going to be denominated in a particular currency. You should be aware of which one it is and to suit your needs. Also be aware that embedded within the strategy rules, which we covered in the due diligence webinar, are execution costs. And the difference between these strategies and investing in, say, risk premia strategies from a manager is that the execution costs for these strategies are fixed. They're fixed and fully disclosed because you have to be able to take the rules and the settlement prices that are referenced and go through the same calculation and arrive at the same NAV as the bank. So that necessitates that the execution costs have to be fixed. And so what you're doing compared to a manager is you're trading off the uncertain and usually not disclosed execution costs of the manager for the fully disclosed and fixed transaction costs that you get from these strategies. So those are the major operational considerations for investing directly in bank-offered systematic risk premia strategies. This concludes our webinar on operational considerations for bank-sponsored systematic risk premia strategies. Please join us for the next webinar where a panel of investors will discuss how to use these strategies. I'm Jerome Abernathy of Hedge Fund Research. Thank you for watching.